Welcome back from that short break and welcome to Financial Markets, and we have some intriguing news concerning BlackRock. It's me, Gloria, together with
Victor.
Yes, Victor, you can start from there and give us an insight.
Well, absolutely, Gloria. Big news from BlackRock. They've made a change in their outlook on long-term U.S. treasuries.
Apparently, and they've been underweight on all those treasuries since late 2022, betting on higher rates, but it seems like they're shifting gears now.
Indeed, they're calling it tactical neutral because they believe we have seen a lot of adjustments in U.S. and 10-year yields.
And these yields suddenly have been a roller coaster ride, 16-year highs, but BlackRock thinks the show isn't over.
Well, they're suggesting that policy rates are nearing their peak, and it means that their next move isn't necessarily towards being overweight on long-term treasuries.
So it's not all sunshine and rainbows for bonds, actually. So BlackRock actually believes that investors will demand more compensation for the bond risk and leading them to stay underweight for a long time strategic horizon.
And not just that, Maria. They have also downgraded high-grade credit further, and it seems they're taking quite a cautious stance here, because what's fascinating is their view on treasury yields, and actually they now see equal odds that yield could swing in either direction.
And that's an interesting perspective. It suggests a two-way volatility that might be ahead, and we have seen all how unpredictable these markets can be.
Yes, and actually let's not forget about the Fed. BlackRock thinks the Fed is nearing the end of its fastest rate hiking cycle since the 1980s.
Exactly, and they also believe that the Fed will continue to hold our policy tight to battle with those inflationary pressures.
Well, it's delicate. It's actually a delicate dance with the central bank, and it's been the center of attention for all investors.
Absolutely, Victor. And Fed's moves actually have had a ripple effect through the entire financial landscape.
Well, that is particularly what we have from BlackRock as per now. But as you know, financial news is fresh every hour. Finance keeps developing, finance keeps evolving, because people that have stakes in these markets need to know exactly what is going on. So please keep a keen eye personally on these particular instruments that we produce to you, so that you know how best you can make of them. So proceeding to gold, particularly in this sector, gold has slipped below the $1,920 per ounce, and a part of that reason for this downward trend is the rise in treasury bills. The 10-year US yields have climbed back above 4.7%.
Indeed, and higher yields in the bond market tend to make gold, which doesn't provide interest, actually less attractive as an investment.
Actually, investors are also keeping a close eye on what the Federal Reserve officials have to say this week. Fed Chair Jerome Powell is scheduled to speak, and it's seen as crucial. Actually, it's seen as crucial for getting insights in the U.S. monetary policy.
Absolutely, Victor. And there's a belief among the analysts that the Fed may be preparing for a long pause in its rate hikes, which combined with the resilient U.S. economy has kept the dollar and treasury yields strong, impacting gold.
Gold has traditionally been considered a safe haven asset, and it's worth noting that it continues to benefit from safe haven demand, especially given the ongoing concerns about the situation in the Middle East due to the Israel and Hamas conflict. And you remember, Gloria, last week gold was shooting up, and investors were, it was a pick and play thing. You want to be sympathetic, but you want to also accept the fact that the war is actually taking gold prices to the sky.
Exactly. And then moving on to our other metal, copper, which has been one of the latest commodities in the spotlight today, and there is not great news from copper.
Well, that's right, actually. Copper prices have hit a 20-week low, dropping to $3.5375 per pound.
Exactly. That's quite a significant drop, Victor, actually. Copper seems to be seen as a barometer actually for the global economy. So what's causing this decline?
Several factors actually seem to be at play, and concerns about global economic growth slowing down have been looming large, and that tends to hit commodities like copper pretty hard.
And the ongoing supply chain distributions are often affecting the demand for copper. So many industries actually rely on this metal when producing stuffers. It trickles through all the markets.
Absolutely. Actually, plus there is this dance between supply and demand. Lower demand meets supply bottlenecks, and that often translates into falling prices.
Exactly. And Chinese economy also closely watched when it comes to commodities, and it's not different from copper actually. So their economic slowdown are driven by various factors. It's also putting pressure on the copper prices.
Well, of course, that is it is indeed a delicate dance, and of course, the massive consumption of copper it must be hitting China as hard as possible, because the Chinese market, it consumes a lot of copper on an annual basis. But so it is not just one thing, but a cocktail of global economic uncertainties and that are affecting copper. But what about the broader implications?
Well, Victor, it's just not about the red metal actually. When copper prices drop, it often raises questions about the health of the global economy. Investors may take it as a sign to trade cautiously.
Yeah, and actually that cautious approach might ripple into other commodities as well, and even the broader stock markets. It's all actually interconnected.
Exactly, and we're in a world where everything is actually interlinked. A hiccup in one sector could cause repercussions in the other sectors.
So whether you're an investor or you are just keeping an eye on the news, the message seems to be the same. Keep an eye on copper. It's got stories to tell.
Exactly. And then moving on to the Mexican stock markets, we have seen some exciting developments in the south border in Mexico. The Mexican stock market really had quite the day.
Actually, the IPC stock saw a nice 0.9% uptick, closing at 49,823 points, and actually investors seem to be in a buying mood.
Absolutely, and there's a couple of stocks that really stood out today. We have CEMAX shares that shoot up by around 3.9%, and Televisa wasn't far beyond. Actually 3.4% gain.
Yes, actually Cemex is a bigger player in the construction and cement industry, and when those stocks do well, it often indicates optimism about infrastructure development.
And Televisa, as one of the largest media companies in the Spanish-speaking world, has its fingers in many pies. A rise in their shares could mean good news for the broader media sector.
Now, what's really interesting is the peso's performance. It strengthened against the US dollar, going from 18.09 to 17.89. That's a significant shift.
It is, Victor, and the currency strength is expected to play a role in the upcoming third quarter earnings sessions. This kicks off in this week.
Indeed, Gloria. And this dynamic can be a game changer actually for many companies. Those with operations mostly in Mexico and some costs in dollars could see a boost.
Right, and consumer good companies and retailers often benefit from a strong peso because it's more of their products and more affordable for their customers.
But there's another side to the coin, and companies that export or have a large portion of their sales abroad might feel the might feel the pinch actually.
Exactly. So when we move into the earnings season, we'll be keeping an eye out for how this peso-dollar dance impacts different sectors.
Absolutely. These currency fluctuations often reveal a lot about the state of the global economy and how it impacts specific business decisions.
Exactly. So as we round up our discussion today, we would love to end this with insights concerning the financial news today. Well, we see Eriscon that has released its third quarter results for 2023.
Certainly. Well, they reported that the group's organic sales declined by 10% year to year, and specifically the network segment saw a 10% organic sales drop, while enterprise and cloud software and services sales experienced organic growth.
That's right, Victor. And their gross margin, excluding restructuring charges, was 39.2%, which was impacted by a shift actually in business mix within the network segment. So this actually has affected the reported gross margin as well, which was around 38.4%.
So obviously the reported earnings before initial tax or EBIT was actually a negative 28.9 billion, which is actually quite a shift from the positive EBIT to 7.1 billion in the previous year. Actually, this substantial decrease was due to a negative 31.9 billion impairment of goodwill related to the acquisition of Vonage.
They actually also mentioned that their EBITDA, excluding restructuring charges, which amounted to around 4.7 billion. However, the EBITDA margin was 7.3%, which was a drop from 11.3% in the previous year. So this reported EBITDA was 3.8 billion with restructuring charges factored in.
Well, the cloud software and services segment managed to break even on the earnings before initial tax appreciation on a rolling 4-quarter basis. This is part of their turnaround strategy for this segment.
And in their enterprise segment, they had a second consecutive quarter of positive EBITDA in global communications platform. So they're just showing some growth roles.
Well, actually, they also talked about a goodwill impairment attributed to their Vonage acquisition, and it talks about the 32 billion macroeconomic factors like rising interest rates and changing demand trends have indeed affected Vonage's market capitalization.
That's a significant hit they've took, Victor. But it's also interesting to see that they mentioned the new milestone in partnership with telecom unlocking market opportunity. This was estimated at around 20 billion USD by 2028 through communication and new APIs.
Absolutely, Gloria. Actually, by offering these APIs to developers and enterprises, they are creating new ways for operators to monetize their investments in mobile networks. And it's all about fostering innovation and expanding their business.
Exactly. And lastly, they also discussed their future outlook, experiencing an expectation of continued uncertainty in the mobile networks business, which may persist into 2024.
Well, their long-term earnings before initial tax and appreciation margin target of 15 to 18% remains intact, and they are focused on executing their strategy, managing their balance sheet, and controlling their costs.
So Ericsson actually seems to be dealing with a challenging environment, but they're actively addressing these challenges and focusing on what they can control.
That's right, and it's all about navigating through uncertainties and staying resilient. And actually, with that is actually a wrap up of these particular financial updates.
Exactly. Thank you for tuning in into Smart 24. It was Nampiji Gloria Christine together with
Victor Chibiru.
We'll be back with more updates as of tomorrow. Thank you.